Imagine walking into a bank where your money doesn't grow through interest, but through real business, real assets, and real partnerships. A bank where profit and risk are shared, not pushed onto you. A system where stability is prioritized over speculation, fairness over exploitation, and transparency over complicated financial tricks. Now imagine that this system, once limited to certain regions, is now gaining massive popularity across the world, from the Middle East to Europe, from Asia to Africa, even in countries where Muslims are a minority. Why is this happening?
Why millions of people, Muslims and non-Muslims, turning to Islamic finance as a more ethical, stable, and trustworthy?
And what makes this system different from the interest-based banking we've all grown up with?
These questions are becoming more important every day, and today, we're going to explore them together. Before we dive deep into the concepts, let's set the stage. Islamic finance is often misunderstood as simply banking without interest. It's a system designed to prevent exploitation, avoid unnecessary debt, and connect money directly to productive activities. In this video, we'll explore why Islamic finance is rising so fast across the world, why Islam forbids interest, and what economic logic lies behind that rule. Why Islamic banks function differently, even though they may look similar from the outside, and why asset-backed financing is the foundation of the entire system.
By the end of this video, you will not only understand how Islamic finance works, but also why so many experts believe it offers solutions to some of the biggest financial problems of our time. Let us begin.
Why Islamic finance is gaining popularity?
Across the world today, we are seeing something remarkable. People are actively searching for financial systems that feel ethical, transparent, and stable.
Islamic finance has stepped into that space as a powerful alternative, not just for Muslims, but for anyone who is tired of debt traps, aggressive interest rates, and speculative financial products.
After the global financial crisis of 2008, many began to question how money was being handled, how banks created wealth from interest, loans, and risky investment schemes that often collapsed entire economies. Islamic finance, built on real assets and real economic activity, stood out as a model that doesn't depend on gambling like speculation or complex derivatives.
Another major reason for its rising popularity is the growth of the global Muslim population.
We are talking about almost 2 billion people worldwide who want financial products that align with their faith, from saving accounts to home financing to investments. Muslims are increasingly
choosing halal options.
But what surprises many is how non-Muslim countries are adopting these systems too. The UK, for example, has issued multiple sovereign Sukuk Islamic bonds, and they were oversubscribed within hours. Countries like Malaysia, Saudi Arabia, UAE, even Luxembourg and South Africa are now major players in Islamic banking. There is also an ethical awakening among young people. More people want investments that avoid harmful industries, avoid exploitation, and support real economic growth. Islamic finance promotes exactly that. No interest, no excessive uncertainty, and no investments in destructive or unethical sectors.
Instead, it focuses on shared risk, fairness, and trading in real assets. So whether it has the growing demand from Muslims or the universal desire for ethical finance,
Islamic banking is rising because it offers a model that feels balanced, stable, human-centered, and morally grounded in a world where financial fairness is becoming rare.
Why Islam forbids interest?
To understand why Islam strictly forbids interest, we have to understand what interest actually represents. Interest creates money from money without effort, without sharing risk, and without adding real value to society. When a lender charges interest, they profit regardless of whether the borrower succeeds or fails. The borrower carries all the pressure, and the lender's wealth keeps increasing without contributing to any productive activity. Islam views this as fundamentally unjust because it creates a system where the rich keep getting richer while the poor sink deeper into debt. Another reason interest is forbidden is because it leads to exploitation. Even today, millions of people across the world are trapped in debt cycles paying interest for years without ever reducing the actual amount they owe. High-interest loans, especially in developing countries, destroy families and businesses. Islam promotes a financial environment where people support each other, where wealth circulates, and where economic relationships are built on cooperation, not oppression. They encourage borrowing beyond capacity, inflate bubbles, and reward speculation instead of productive investment. The 2008 global crash showed how interest-driven debt structures can collapse entire economies. Islamic finance, by prohibiting interest, reduces excessive debt and forces financial institutions to participate in real economic activities. Islam teaches that wealth should be earned through effort, trade, investment, and partnership, not through passive guaranteed returns. When banks and lenders share risk with customers, both sides are motivated to ensure the success of a project.
So the prohibition of interest is not only a religious instruction, it is an ethical, logical, and economically sound principle designed to protect individuals and societies from injustice and instability.
Intercover vitamin, why Islamic banks are not conventional banks.
A common misconception is that Islamic banks are simply conventional banks with Islamic terminology. But this is far from the truth. Islamic banks operate on completely different foundations, principles, and structures. The biggest difference is risk sharing. In conventional banking, the bank gives you money and charges interest regardless of your financial outcome. Islamic banks cannot do this.
They must participate in the risk of the transaction.
If a business fails genuinely, the bank may share the loss. If the business succeeds, both share the profit. Another major difference is that Islamic banks must link every transaction to a real asset, something tangible that exists. In conventional banking, money is lent freely without any requirement for asset backing.
This creates loans on top of loans, leading to unstable financial bubbles.
Islamic banks, on the other hand, operate through contracts like Murabaha, where the bank buys an asset
and sells it to the customer at a profit, or Musharaka, where the bank becomes a partner in a business. Every financial movement must involve a real item service or economic activity.
Islamic banks also avoid activities involving excessive uncertainty, gambling-like speculation, or unethical industries. They cannot invest in alcohol, gambling, pornography, weapons manufacturing, or anything harmful to society. Conventional banks have no such restrictions and may invest anywhere as long as profit is ensured. Islamic banks are further supervised by Sharia boards consisting of scholars who audit, review, and approve all products to ensure compliance.
No conventional bank has this system of religious and ethical oversight.
Even the profit Islamic banks earn is not interest. It's generated through valid trade, leasing, or partnership contracts. So while the buildings and stuff may look similar, the underlying philosophy, ethics, rules, and financial mechanisms are completely different.
Why asset-backed financing is important in Islamic finance.
Asset-backed financing is one of the most defining features of Islamic finance, and it exists for a very powerful reason. It ensures that money is always connected to something real. In Islamic finance, money itself is not a product. Money cannot be rented out like a house or a car. Money can only be used as a medium of exchange. So when banks lend money, it must correspond to a real economic activity. This prevents the creation of debt that has no substance behind it.
For example, if someone wants to buy a car, an Islamic bank does not simply hand over cash with interest.
Instead, the bank buys the car itself, takes ownership, and then sells it to the customer on a cost-plus profit basis through a contract like Murabaha. This ensures transparency. The buyer knows exactly what the bank paid and how much profit is being charged. Both sides know what asset is involved and who owns what at each stage.
Asset-backed financing also protects the economy from harmful speculation.
When money circulates without real assets, financial bubbles form, prices inflate artificially, and eventually those bubbles burst, causing economic crashes. By requiring every transaction to be tied to a physical asset, Islamic finance stabilizes the system and reduces excessive risk. Asset-backed financing also encourages real trade, job creation, and productive industries. Instead of focusing on lending money for profit, Islamic banks become participants in genuine economic activities like housing, transportation, agriculture, manufacturing, and business development.
This links finance directly to the real economy, not just paper profits.
In a world where digital trading and speculations dominate, Islamic finance pushes the system back toward fairness and authenticity. It grounds financial transactions in something tangible, real, and sustainable, ultimately benefiting both individuals and society at large.
Common myths about Islamic finance.
Islamic finance is growing fast, but with its growth comes many misunderstandings. One of the most common myths is that Islamic banks simply replace the word interest with profit and operate the same way as conventional banks. This is completely false. In Islamic finance, profit only comes from real trade, leasing, or partnership, not from lending money. In interest-based systems, money earns more money automatically. In Islamic systems,
Profit must be tied to assets' risk and responsibility.
another myth is that Islamic finance is only for Muslims. In reality, a large number of non-Muslims invest in Sukuk, use Islamic banking services,
And choose halal finance.
for its ethical structure. Many governments, including the UK and Luxembourg, issue Islamic bonds because they are stable, transparent, and asset-backed. Ethical investors globally are now attracted to Islamic finance because it avoids harmful sectors, reduces exploitation, and encourages shared prosperity. A third myth is that Islamic banking is outdated. People assume it belongs to ancient times and cannot fit into modern financial markets. But today, we have Islamic Fintech startups, digital Islamic banks, Sharia-compliant investment apps,
Halal cryptocurrency solutions.
and global Sukuk markets worth hundreds of billions. Islamic finance has evolved into a technologically advanced, globally competitive sector. Another misunderstanding is that Islamic banks cannot make profit. In reality, they can, and they do.
But their profits come through trade, investment leasing, and partnerships instead of interest.
Their profitability actually becomes more stable because it's backed by real assets.
These myths exist mostly because people judge Islamic finance without understanding its principles.
When you look deeper, you discover a system built not on words or labels, but on fairness, transparency, and ethical financial practices that benefit the entire society. As we come to the end of this journey, take a moment to reflect on what we've explored. Islamic finance is not just a set of rules or a replacement for conventional banking. It is a completely different way of looking at money, responsibility, and society.
It challenges the idea that wealth should grow without effort, that debt should control lives, or that profit should come at the cost of fairness.
Instead, it promotes a system where money serves people, not the other way around. Throughout this video, we saw why Islamic finance is gaining popularity across the world. Why interest is prohibited, how Islamic banks truly differ from conventional banks, and why asset-backed financing is essential to creating stability and transparency in financial transactions. But beyond the concepts and the mechanisms, Islamic finance carries a deeper message, a message of justice. It reminds us that financial systems must protect society, uplift communities, and encourage real economic growth. In a world struggling with debt, inequality, and financial uncertainty, people are searching for models that feel balanced and ethical. Islamic finance offers that balance, not only to Muslims, but to anyone seeking fairness and clarity. If this video helped you understand Islamic finance better, let me know in the comments which concept you want me to explain in detail next. Thank you for watching, for learning, and for staying with me till the end. Remember, a just financial system doesn't just create profit. It creates trust, stability, and long-term prosperity. I'll see you in the next video.
Allah Hafiz.